Hey friends, I'm back. I'm excited because the bluest of blue chip stocks, the high quality stocks, the CPG stocks, the core stocks, they are correcting right now. The stock market is correcting. It's not only the ancillary positions. It's not only the second rate quality positions. It's the best positions right now are correcting. Stocks like the Hershey Company, for example. I want to cover 3 stocks in the video today, household brand names that I love that are correcting. I've got this cool Hershey pouch. What's inside of this thing? I don't remember. Let's see. Oh yeah, lots and lots of money. There's money in here. This money represents the powerful dividends that this company pays. But before I get into the 3 stocks today, I want to share an illustration with all of you that will help clarify exactly what's happening in the stock market right now. It is a scenario that keeps repeating itself over and over and over throughout the years. As investors, it's hard actually to follow the simple rules that I will show on the next screen. And that's why I want to share it. It's a good reminder for myself. So check it out on the screen, and I hope it's interesting to all of you as well. There's a 4-tier cycle, a 4-stage cycle that just keeps repeating itself. And the first stage of this cycle, as you can see in red, step 1 is a terrible situation will present itself. This terrible situation will generally seem to have no solution. At least that's how the media presents it. Right now, we're facing out of control inflation. Too much money was printed during the pandemic recovery. Prices are very high. Prices for consumers especially are very high. Input prices, though, for companies are high as well, but they're passing that inflation along to the consumer. And so because of all of this, because of the high inflation, interest rates are really high right now. The Federal Reserve has kept increasing the Fed funds rate. And this Fed funds rate has really permeated throughout society right now in terms of different types of interest rates being high. We're now seeing Treasury rates really high, short-term and long-term rates. We're seeing mortgage rates really high right now. This is affecting home sales. This is affecting home buyers being able to go out and purchase a home. And so there's also other bad news right now as well. The government was almost faced with a shutdown. It was averted at the last possible minute, but we almost faced a government shutdown here in the US, and that would have been really terrible because the stock market would have probably fallen even more than it already has. But the stock market started correcting in anticipation of that. So we've got Pillar 1 of this 4 kind of step process. It's always some terrible bad news, and usually there's no solution to that in sight. What happens next, as you can see on the screen, the second thing that happens in that process is the stock market crashes. It will maybe taper off a little bit like it is now, or it will even head into a full collapse. Now, we're seeing right now, even the core stocks are correcting. It's not only the ancillary stocks. It's not only the second-rate stocks. In fact, in my last video, I'll link to it in the pinned comment below, I already covered 3 stocks that have corrected quite a bit. And those 3 even that I covered, Raytheon Technologies, Realty Income, and General Mills, those are all core quality stocks. These are great stocks. Today I want to present 3 more. But as you can see on the screen in front of you, step 2 of this process, we're not only seeing ancillary stocks correct, we're seeing really high quality stocks correct because there's no solution for this terrible inflation and this, quite frankly, mismanaged situation right now just overall. It seems like there's no end in sight to what's happening in our economy and in our government. And so will stocks ever come back? Right now, you would think that this correction is just going to keep happening forever. The media makes it seem like there's no solution. What happens? I bold this at the bottom, but the average investor sells. During this phase of the process, the average investor sells. In my humble opinion, though, this is a great time to be buying. And this is the message for myself right now. It's difficult. There's a lot of fear out there. I don't know the solution to what's happening in our country and around the world right now. There's a lot of bad news. I kind of see why the media is painting a bad picture in some ways because there's a lot of bad news. But I know from experience as an investor that when I'm in phase 2 of this 4-phase cycle, I need to be buying. And so I'm sharing 3 stocks today actually that I plan on buying. I plan on adding to them. But what happens next in this cycle, as you can see on the screen in front of you right now, Now, the next thing that happens, step 3, is, hey, miraculously, a solution is found. The problem is gone. The original problem, it goes away. Oftentimes, it seems like it goes away overnight. A perfect example of this is the pandemic. When stocks were crashing during the pandemic and I was buying stocks like Starbucks, for example, almost every single day, we didn't think this was ever going to end. We didn't see a solution. But then miraculously, there was a solution. No one's really thinking about that anymore. Stocks had recovered from that. The problem is gone. And so the key nuance here, the key point to remember is that even when you're in steps 1 and step 2 of this whole thing, it seems like there's no solution. Oftentimes, a solution is right around the corner. And if there's not a solution, the news cycle will just change to something else. And so what seemed like an impossible obstacle, it's just now forgotten. That's what happens in step 3. We have all lived through this. I think the best recent example of this is the pandemic. I think the example before all of that was the overall great financial crisis. I think during the great financial crisis, none of us thought, hey, is this ever going to end? But miraculously, it did end. And so what we're going through right now with this inflation, with these problems in the government, I believe it will pass. I don't know what the solution is, but I'm buying. Now, what happens after phase 3 is you can see on the screen in front of you right now, we have phase 4 of this 4-phase process is, hey, the stock market recovers. It surges to new heights. Stocks are going way up. We start thinking, will the stocks ever correct again? Sometimes I will even go out and start buying ancillary positions, really ancillary positions, because I can't find value anywhere else. And I'm probably better off not doing that. I'm probably better off just saving money for the next correction. But hey, I'm human. You've seen time and time again on my channel here, I share my journey. I share all the successes. I share all the lessons I've learned as well. And oftentimes when we're in phase 4, you'll see me buying weird stocks. And oftentimes that is a good indication that, hey, this is probably a better time just to save money. But as you can see on the screen in front of you, in phase 4, the media at this time kind of shifts the story. The media makes it seem like, hey, this bull market will never end. It's unstoppable. Unfortunately, as I bold and underline here, the average investor is buying aggressively. In my humble opinion, during phase 4, the best thing to do is to hold on, maybe to reinvest, maybe to buy here and there, but more often than not, just to kind of hold what the investor has accumulated and stockpile cash. At least that's what I plan on doing in the future. I'm sharing my personal journey here on YouTube only for informational purposes. But that's what happens and why the average investor, and then before I take this off this screenshot, you can see the arrow pointing all back to number 1. Then we'll find some terrible situation again. The history will repeat itself, so on and so forth. But the problem here is the average investor is buying aggressively during the end of the cycle, during phase 4, when the average investor really should be buying aggressively during phase 2, when all of the bad news is out there in the media. Now, thankfully, right now, there is a lot of bad news, and I love it because as dividend stocks go down, high quality dividend stocks, the money I reinvest and the money I deploy, it buys me more cash flow. The money I have to invest, it gets me further because lower stock prices, higher starting yield. And so there's an inverse relationship. A falling stock market is great for dividend investors who are actively accumulating assets that produce cash flows. Okay, and so I want to share the 3 stocks that are on sale right now. You all know I'm already going to talk about Hershey Company, so this is going to be a fun one. But I got some more props. And so I have the huge thing of Clorox wipes. Check this out, the value pack from Costco. How many wipes are in this thing? 425 wipes. How amazing is that? Now, I want to talk about Clorox because this one is a microcosm of this particular scenario in this stock alone. And this one kind of followed its own cycle. And so I just shared a 4-step cycle. That was a kind of a macro cycle that applies to the overall economy. But sometimes that macro cycle, I can take it and I can point it on to a particular situation or onto a kind of a micro situation. And what happened with Clorox is it was reversed cyclical. It was so interesting because when everything else was recovering from the pandemic, this particular stock was falling. It was not doing so well. And then it recovered. Now it's falling again. But it's interesting. It was off cycle a little bit. And the reason is so many people stocked up on these wipes that after the pandemic, they weren't selling almost any product because people were buying these wipes and other Clorox products. They couldn't sell it after the pandemic. But then people went through their pent-up back stock of such products, and then eventually they started kind of recovering and the company was back to status quo. They were selling the products on more of a normal time frame. It was hard during that moment as an investor to own Clorox because they were losing money for a period in time. They were having problems. This crazy good dividend CPG company that's been increasing dividends per year on average forever, this company actually had gone earnings negative. People were wondering, were they going to cut the dividend? They didn't. They kept raising it a little bit slower, but they kept it up. But this is a perfect example of keeping the faith when times are bad, adding to the stock when times were bad, because it did come back. But that's a micro example of the overall macro scenario I just discussed. The last one I want to share, I've got the Starbucks here, but it's not actually Starbucks. This is distributed and produced by PepsiCo. I want to talk about PepsiCo. So that's another one I love right now. It's rare. It goes on sale. I don't really have any Pepsi products in our house other than this. That's why I share it. I'm not talking about Starbucks. I love that company too. It's my number one position. But I want to talk about PepsiCo. So the next thing I want to do is share on the screen. Check it out. These are the positions. All right, let's do it. And so as you can see, I've got PepsiCo, Clorox, and Hershey there. I don't want to go into so much detail into all the metrics today because I want to have a short and sweet video. I've been very busy at work. I have a lot of updates I've been sharing on social media, so make sure to follow me. I have in the pinned comment below my Instagram and my Twitter. I've got some fun updates, especially on Instagram, but I just got to get this video out there and I got to get back on my schedule of posting videos. I miss all of you. Can't wait to see you all in the comments below. So I've just got the 3 stocks here. Now, first thing is all of these are trending off of their 52-week highs. Here's an important point. In my last video, I also shared 3 stocks, Raytheon, Realty Income, and General Mills, and they were off the 52-week highs. And then I started sharing that, and this message spread. I started getting kind of hate in the comments. Picture me rolling, by the way. Anyway, but they're saying, oh, you just buy stocks because they're off the 52-week high. You don't know what you're doing. No, of course that's not the case. The reason I look if a stock is off its 52-week high is not to assess value, but to pinpoint my attention. I'm a busy person. I don't have very much time. I own 37 positions. In my universe of stocks that I follow, I need to have just a leading indicator, what might be on sale, what might be something to look at. And a great way that I can tell which stocks to start looking at are the ones that are off the high. It doesn't mean that it's a value, but it means I can focus my attention there and look for value. But as you can see on the screen in front of you, all of these are off the 52-week high, so they caught my attention, especially seeing a stock like Hershey and Clorox off almost 30%. That is so rare. And so then I started looking at the EPS estimates. I started looking at the forward PEs. To see forward PEs for 2024 for Clorox and Hershey under 20, that is rare. Now, I understand these aren't deep discount value. I realize these are still expensive. I realize, especially for PepsiCo, it's a 22 PE for 2024 forward. That is not super cheap. But these are blue chip, high quality, core style stocks, and PE is relative. PE is different for different types of stocks. For quality stocks, for the quality and caliber of these stocks, I trust these companies with my money more than I would even the government. I think that these are countries of their own in some rights based on the scale of these companies. I guess Clorox is a little smaller, but PepsiCo certainly PE tends to be higher. I'm talking about a range. This is lower in the range of a PE ratio that I would expect for such high quality companies. But as you can see, let's keep going. The next thing I want to share is just dividends. Another sign of value that I'm seeing for PepsiCo. It's very rare that I've seen the dividend crosses that 3% mark. I highlight anything here that's interesting to me. Clorox 3.7. That's pretty rare, especially now that the company is back on the right track. Hershey, I don't really highlight there. They have a lower payout ratio. Starting yield is only 2.3%. I don't own Hershey, but I have purchased it for both of my kids. It's a longer term position. It's a longer term outlook. It does have a lower starting yield, but the compound annual growth rate of the dividend, as you see next, is pretty high. Pepsi, it's 9.5. I don't think that's going to continue in perpetuity. I don't know if it's sustainable. Clorox is 4.6. I think it might go higher than that, possibly in future years as they keep getting back and they recover after that wacky counter-cyclical sales and earnings that they had from the pandemic. I think it could grow a little quicker than 4.6%. And Hershey is at 9.4%. I think that will probably continue for a while just because they are in all-out growth beast mode. Now, the market cap is huge for Pepsi. It's a little lower for Clorox. It's pretty big for Hershey as well. Now, I just took the current compound annual growth rates of the dividend and I estimated what would the yield on cost be 5 years out, 10 years out. Based on current growth rates, you can kind of get a sense there where it would be for Pepsi, Clorox, and Hershey. Now, I love Pepsi 10 years out at 7.39%. That's without reinvesting dividends even, and it's pretty solid. Now, what I would say, of course, with Pepsi is I don't know if that compound annual growth rate can continue in perpetuity, but we shall see. The important thing to mention, though, when I'm looking at dividend yields for these versus Treasury bonds, and this is really the trade-off here. There's so many nuances to the presentation today. I will get into Treasuries in a minute. Actually, I'm going to do that. This is going to be a little bit kind of scattered today, but it's important because there's a lot of points I'm trying to illustrate. I want to share. Just check it out on the screen right now. Check out where Treasury yields are at. You can see it in front of you right now. It is phenomenal. Treasuries on the 3-month Treasury are at 5.486%. The 6-month, 5.57%, 1 year 5.5%, 2 year 5.1, 5 year 4.7, 10 year 4.685. You can see these days the game has changed. Investors are now being paid to wait. There's a trade-off. This hasn't existed in recent history. Dividend investors, when Treasury bonds are really low, it kind of didn't even matter where the starting yield was. It was going to be better than a Treasury bond. And there wasn't really this comparison, oh, is it ever going to catch up or surpass Treasury bonds? That wasn't really a factor. Anyway, though, check it out. I want to share a few thoughts on that. So investors are now being paid to wait. This wasn't the case since probably all the way back in 2008. We're in a different investing environment. Investors don't need to buy dividend stocks to generate immediate yield. They can buy treasuries, which are really low, almost risk-free. Investors are now incentivized to primarily purchase stocks only when they're on sale. That's why I'm excited about this video, because when stocks are on sale, they offer capital appreciation and some good starting dividend yield and yield on cost upside. Now, thankfully, as of now, I'm seeing some stocks on sale, but if I didn't see so many stocks on sale, I'd be tempted just to wait. And just waiting, meaning putting my money in a savings account or treasury bonds that have these higher yields. But the thing I want to say overall is now stocks are on sale. I'm seeing them on sale. So I'm incentivized to start buying individual dividend stocks. When they're not on sale, I'm either just putting money in SCHD or I'm even stacking cash just in cash savings, treasuries, similar instruments to generate yield. One nuance, though, again, worth mentioning in this presentation today is the dividend stocks I'm mentioning offer qualified dividends. They have a more favorable tax rate. They're taxed as long-term capital gains, whereas treasuries, the cash flow that comes through, it is taxed as ordinary income. Now, with treasuries, they're exempt from tax on the state and local level, but they are taxed at the federal level, but it's taxed as ordinary income, which is a higher tax rate, generally speaking, than long-term capital gains. Anyway, even putting the tax stuff aside, and of course, I'm not suggesting or offering any tax advice in the video today, just sharing my personal journey for informational purposes only. I have to make these comparisons. Is it even worth investing in dividend stocks anymore? That thought crosses my mind. Right now, with stocks on sale, just speaking to my personal situation, I am compelled to buy individual dividend stocks again. But let's go back. I know I'm jumping around. Check it out on the screen. I want to go through the 3 stocks I'm talking about today again. As you can see, I have some projections on yield on cost, where it could be. And the reason I brought up the treasuries, again, is this is where the comparison of the treasuries comes in. And you can see where we're at. Now, there is an inflection point. And worth noting with dividend stocks is yield on cost, especially for high quality stocks, that's kind of locked in, I wouldn't say forever, but averaging over the course of my 37 positions. Of course, there's going to be some surprises in there, but in general, the yield on cost is there, whereas treasuries, yields could go back down. The only thing I could lock in maximum would be 30 years on the long bond, but these are more or less locking in these yields growing in perpetuity forever, averaged, of course, across all my positions. There's going to be some surprises, dividend cuts, that kind of thing in there. Now, I have a few notes in there. Hershey, I think you got the Clorox and Pepsi notes. Hershey, it's just fun. It never corrects. How's it correcting? That's pretty cool. What I like about these stocks is they're everyday products that consumers need. CPG companies, they tend to perform well in strong times of growth, but recessions too. The businesses are easy to understand. They bounce back from difficult times. Clorox is a perfect example. They had weak performance after the pandemic. They have now bounced back. They have long histories of dividend growth and opportunity for future dividend growth. So what I don't like as much about these particular stocks is the store brands, the Amazon brand, the generic brand. It could erode performance. I don't really see it with Pepsi. I don't really see it with Hershey as much because the brands are so iconic. But with Clorox, do I really need the Clorox wipes or could I get a more generic wipe? That's a real business risk. Input cost, the inflation cost, it's real. They've been passing it to consumers, but can they do that forever? Probably not. In the case of Pepsi and Hershey, will a health-conscious society move away from such treats? It's a risk. Valuations are still not cheap. I already talked about this. They're relatively cheap to where these companies historically have been. And so those are the three stocks. Put in the comments below what you think. Put in the comments below if you see any other value stocks in the market today. I want to close out with just a few more high-level thoughts. As you can see on the screen, I have some thoughts for today. So first, quality individual dividend-paying stocks, they're starting to correct. This is catching my attention. Lower share prices means my money deployed or reinvested goes further. At a 3% starting yield on these kind of core quality stocks on qualified dividends for the best companies in the world with reasonably strong compound annual growth rates, I'm compelled to buy such stocks even as compared to the high Treasury yields right now. I do not automatically buy stocks just because they're off the 52-week high. That said, when I see a large percentage drop, it helps me focus my attention and start researching out of my universe of 37 positions I follow, which ones could possibly be on sale. That's an important point. Picture me rolling. So on the third point, I always enjoy buying CPG because they provide goods we cannot live without. In the past, I've been known as CPG Ian, and so I placed a lot of historical emphasis on CPG. I am excited to get back to my roots. If you enjoyed the video today, don't forget to subscribe to my channel. I promise I have more videos on the way. Thank you for being patient. Thank you for waiting. I shared some life updates on Instagram. Check it out in the pinned comment. Been working really hard on my real estate profession, and so my real estate deals. It's been really busy. I'm excited to be back here, though, on YouTube. I missed you all, and I look forward to seeing you in the comments. Before I go, in terms of a full disclosure, I am long the stocks mentioned today. I am long PepsiCo, ticker PEP, Clorox, CLX. My kids are both long Hershey, HSY. Also, I'm long Starbucks, SBUX. I am long Raytheon Technologies, RTX, Realty Income, ticker O, and General Mills, GIS. I'm also long Treasury bonds. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest, please consult your licensed financial advisor first. It's possible to lose money in the stock market. Also, I'm not a licensed tax advisor. I'm not offering any tax advice. I have additional disclosures and disclaimers, as always, in the description below. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.